Welcome to the data dawning, where the data speaks. We listen. It's time to unlock the numbers and decode the story.
Right. And today we're really diving into quite a complex picture, looking at a whole range of sources.
Yeah, a real mix. We've got Bitcoin metrics, macro stuff, detailed market analysis.
Expert interviews, financial news, the whole lot.
Okay, so the goal here isn't just drowning in numbers. It's about finding a path through it all.
Exactly. Pulling out the key bits.
Right. What are the crucial nuggets from all these different views? Where do they agree?
And maybe more interesting, where do they clash?
Yeah, where are the contradictions? We want to see what the data is really saying underneath.
And hopefully help you get up to speed fast.
Maybe spark a few aha moments, connecting things you hadn't thought about before.
It's definitely about cutting through the noise. And there's a lot of it right now.
Oh, sure.
So we'll start granular, yeah. Look at Bitcoin itself. Some unique market structure stuff there.
Okay. Micro first.
Then zoom out. Big picture macro, global growth, admin views.
You then drill back down.
Yeah, specific market segments, consumer trends, what companies are doing. Then try and tie it all together.
See what it means for you, the listener.
That's the plan.
Sounds good. Let's jump in then. Get our hands dirty with crypto liquidations first.
Let's do it.
In today's BTC liquidation heat map. Okay, this might sound a bit technical if you're not, deep into leveraged crypto trading.
Yeah, it can seem that way.
Yeah.
But understanding it gives you a real peek into some powerful market forces.
So a liquidation event. That's basically when an exchange forces a trader out of their position.
Pretty much.
Right.
If you're using leveraged borrowed money, your initial deposit, your margin, has to cover potential losses.
Right. Magnifies gains, but also losses.
Exactly. So if the price moves against you too far and your margin isn't enough anymore.
The exchange steps in.
Yep. Closes the position automatically, protects them, stops you going to negative balance. Happens to longs if price drops, shorts if price rises.
And this heat map, it's like trying to predict where those forced closures might happen.
That's the idea. It's looking ahead, trying to identify price levels where lots of these leveraged positions are clustered.
Based on market data, open interest, leverage estimates, that kind of thing.
Exactly. It crunches that data, calculates potential liquidation levels, and plots them on a chart.
And the colors are key, right? Purple is fewer, yellow is a lot.
Right. The color intensity shows the concentration. Purple, blue, green, up to yellow for the really dense zones. High number of predicted liquidation levels packed together.
So yellow means watch out. Potential liquidity zone, maybe volatility.
That's the signal it's sending.
Mm.
Hey, lots of leverage bets might blow up here if the price hits this spot.
Okay. Now, the source mentions some important caveats. It's not a guarantee.
Absolutely crucial. It predicts where liquidations might start. Doesn't mean they all happen, doesn't predict the exact volume or where a cascade might stop.
So the actual number might be lower.
Could be. And you have to look at it relatively. Compare the intensity of one yellow zone to another on the map. Where are the biggest concentrations?
Got it. So looking at the specific 24-hour heat map image we have, it's not evenly spread out. There are definite hotspots.
Very clear. You see these bright yellow bands standing out.
Why are they concentrated?
There's a prominent one around the 106,000 level. Suggests a lot of leverage piled up there.
Okay.
And then just above that, another significant zone, maybe even larger, looks like it's between roughly 108,000 and 109,000.
And the scale goes up towards 111K.
Yeah, but those yellow areas around 106K and then 109K, they really grab your attention, potential volatility zones.
So these are levels you definitely mark on your chart if you're watching BTC. But how do traders actually use this? What are the strategies?
The source highlights a couple of main ways. One is this magnet zone idea.
Magnet zone? Sounds intriguing.
The theory is a big cluster of potential liquidations can actually pull the price towards it.
How does that work? Is it because triggering them causes a cascade?
That's part of it. Liquidated longs force market sells, liquidated shorts force market buys. That moves price, triggers more, and so on.
Like dominoes.
Or, maybe simpler, smart traders see these levels, anticipate action, and place their own orders there, adding to the pull.
So traders use it to gauge potential direction, or maybe for convergence trades.
Could be. It's about anticipating where the market might be drawn, almost like a self-fulfilling thing, you know?
Right. The prediction influences the behavior, which makes the prediction happen. Interesting. What's the other way traders use it?
As potential support resistance zones, especially larger players, the whales.
Because it's an area of high liquidity.
Precisely. Think about it. If you know a bunch of forced selling from long liquidations or forced buying from short liquidations is likely to happen at a certain price,
That's a place where you can potentially fill a really big order without moving the price too much against yourself.
Exactly. The liquidations provide the other side of the trade. A whale wanting to buy big can absorb the forced selling. A whale wanting to sell big can meet the forced buying.
Less slippage for them. Clever.
Allows them to get in or out quickly at potentially better prices than they might find elsewhere.
And the source mentioned price can reverse after these zones are hit.
Yeah, because once those big orders are filled, maybe the initial burst of liquidations is over, the pressure that pushed the price there can ease off. That can lead to a natural reversal.
Wow. So the vulnerability of some traders creates strategic entry-exit points for others. It's a whole ecosystem.
It really is. Liquidations are a huge part of crypto market dynamics. They inject volatility, fuel big moves.
So understanding where they might happen gives you valuable context.
For sure. Helps you understand market structure, anticipate potential flashpoints, maybe informs your own risk management, highlights just how much leverage shapes price action.
Okay, that's a fascinating look at the short-term sort of structural plumbing of the market. But what about the bigger picture? Bitcoin's overall value, cycle position.
Right, for that longer-term view. We can look at tools like the MVRV Z-score. It uses on-chain data, gives a completely different perspective.
MVRV Z-score. This one tries to spot the extremes, right? Like, is the market massively overvalued or undervalued compared to history?
That's the goal. Cut through the daily noise, see if we're in bubble territory or maybe a deep trough relative to a more fair value derived from the blockchain itself.
Trying to spot that euphoria or capitulation, how does it work? 3 components.
Yeah. First is market value.
Yep.
Super simple. Current price times coins in circulation.
Standard market cap.
Mm.
The black line on the chart we have.
Yep. Just like for stocks. Second component is realized value. This is the clever bit.
Okay, what's realized value?
Instead of using today's price for all coins, it looks at the price of each Bitcoin the last time it moved on the blockchain.
Last time it changed hands between wallets?
Exactly. It sums up the value of all coins based on their last transaction price, averages it out, then multiplies by the total grind supply.
So if I bought way back when and haven't touched my Bitcoin, its value in this calculation is based on that old price, not today's.
That's right. It's like an aggregate cost basis for the whole network. Because it anchors to the last movement price, it smooths things out.
Strips out short-term sentiment, like the source says, less sensitive to daily swings.
Yeah, it moves much slower than market value, considered a more true long-term measure by people who use it. That's the blue line on the chart.
Okay, market value is current hype. Realized value is aggregate cost basis over time. And the Z-score, the orange line.
The Z-score ties them together statistically. It measures how many standard deviations the current market value is away from the realized value.
So it's looking for big deviations, when the current price gets really stretched compared to that longer-term realized value.
Precisely. It highlights the extremes in their relationship relative to history.
And historically, that orange line has been pretty good at flagging major cycle turns.
The data suggests it's been remarkably effective when that orange Z-score line spikes up into the pink box at the top.
Market value way above realized value.
Yeah.
Extreme optimism.
Right. Historically, that's signaled market cycle tops. The source even claims it picked highs within 2 weeks.
Wow. Okay, that's a strong historical signal for overvaluation. What about the other end?
When the orange line drops down into the green box at the bottom.
Market value way below realized value.
Yep. Extreme pessimism capitulation. Historically, buying Bitcoin during those green zone periods has generated outsized returns, according to the source. Great accumulation zones.
So the million-dollar question, looking at the chart now, where is that orange Z-score line today?
Right now, it looks like it's hovering somewhere, maybe in the 2 to 3 range. It fluctuates, of course.
And critically, how does that compare to those historical extreme zones?
Well, it's clearly below that pink cycle top band. That pink band historically kicks in much higher, maybe Z-scores above 6 or 7.
Okay. And it's above the green band.
Yeah, well above the green oversold zone, which is usually below 0 on the Z-score scale.
So based purely on this historical indicator, we're not in extreme euphoria, not in deep capitulation either, somewhere in between.
Exactly. It's not flashing cycle top imminent based on its past performance. It's in a zone that's often seen during bull markets. But it's nowhere near those blow-off peaks you see on the historical chart, where the orange line went deep into the pink.
And the chart also shows the plain MVRV ratio, the black line.
Yeah, market value divided by realized value. The source mentions it shows general over-undervaluation trends, but finds the z-scores may be more precise for pinpointing those absolute tops and bottoms historically.
Okay, that MVRV z-score gives a really useful long-term perspective. Now, let's try to connect the dots. How does this long-term view relate to the short-term liquidation heat map we started with? They seem like different worlds.
They're looking at different layers for sure. MVRV z-score is about fundamental valuation based on historical cycles and holder behavior. Is the overall price healthy relative to its past?
Suggesting right now maybe not extremely overheated from that cycle perspective.
Right, whereas the liquidation heat map is purely about current market structure. It's driven by short-term leverage. Where are the weak hands concentrated right now?
So you could have a situation like, well, like maybe now, where the long-term metric isn't screaming top, but the short-term heat map shows specific nearby prices are really sensitive to a potential squeeze because of all that leverage.
That's a perfect way to put it. The MVRV z-score is like the climate. Are we generally in a bull phase, bear phase transition? The heat map is of the local weather forecast. Are there potential thunderstorms or flash floods around specific price points today or this week?
Climate versus weather. Got it. Two distinct but valuable lenses. Okay, let's zoom out even further now. The big picture global economy, macro trends.
Sounds good. In today's Macro Minute, Derry Stale highlights some real friction, actually, a clash between big institutional forecasts and administration views, particularly on growth and policy.
He starts with the OECD, the Organization for Economic Cooperation and Development. They put out new forecasts.
Yeah, and they're not exactly cheerful. They cut their 2025 global growth forecast down to 2.9%.
Down from 3.3% expected this year.
Right. And their reason. They pointed to trade anxiety dragging on investment and warned that protectionism is inflationary. So trade policy is seen as a double whammy hurting growth and boosting inflation.
Ouch. And their U.S. forecast was even worse.
Considerably. They see U.S. growth plunging next year, 2025, down to just 1.6%. That's a big drop from the 2.8% they expect for 2024.
And inflation.
They actually see U.S. inflation accelerating in 2025. So slower growth, higher inflation, stagflationary vibes.
Which would probably keep the Fed on hold, right? No rate cuts anytime soon in that scenario.
That's the OECD's take. Fed easing delayed until 2026, maybe longer if inflation gets sticky.
Okay, standard institutional gloom, perhaps. But this is where Darius Dale comes in with a pretty forceful counter.
Oh yeah, he does not hold back. He calls these kinds of forecasts hyper-consensus research views.
Hyper-consensus, meaning everyone expects it.
Exactly. And his argument is because it's so widely expected, there's a high probability that investors who position for that doom and gloom going short, underweighting risk assets, will end up holding the bag.
His thinking is, if it's obvious enough for the OECD to forecast it, the market already knows. It's priced in or won't play out as badly as feared.
That's the core of it. If the OECD can figure this stuff out, he argues, the market pros already have. So it probably won't result in the types of adverse market consequences people expect.
He threw some shade at OECD forecasters too, didn't he?
I bet, yeah.
Yeah.
Said he hasn't seen them celebrated as investors on Wall Street, kind of implying their economic models don't necessarily translate into profitable market calls.
Okay, sharp critique. But he didn't just critique the OECD, he brought in a whole different viewpoint from the Trump administration.
Right. He contrasts the OECD gloom with what he hears from potential administration officials. They're apparently rejecting forecasts like the CBO's 1.8% U.S. growth.
What are they projecting?
They're betting on a GDP north of 3% by mid-2026. Much more optimistic. He even quotes Treasury Secretary Scott Bessent, aiming to slash the deficit significantly, from nearly 7% of GDP down towards the long-term average of 3% by 2028.
Wow, okay. So OECD sees 2% growth, stagflation risk, Fed on hold. Trump admin sees 3% growth, deficit reduction. Polar opposites.
Totally different worlds. And Dale connects this directly back to investment strategy.
How so?
He basically asks, given the administration's optimistic outlook, what kind of assets did they want you in? His answer, risk assets.
Because their scenario favors growth.
Exactly.
Yeah.
So based on that potential policy direction and economic view, he suggests retail investors saving for retirement should generally be fully invested unless they have strong personal reasons not to be.
So he's really prioritizing the administration's outlook over the institutional consensus forecast.
Seems that way. He framed the whole segment as a bit of a rant, but hoped it was helpful. His conviction seems to be that betting against risk based on consensus gloom, when a potential incoming administration is signaling strong growth, could be a mistake.
It's a fascinating take on how political wins and policy intentions can be seen as more actionable market signals than traditional economic forecasts sometimes. Quite provocative.
Definitely highlights the complex interplay.
All right, let's shift gears again. From that high-level macro debate, let's dive into the nitty-gritty from Yahoo Finance. They covered a ton of ground.
Then Yahoo Finance dives into
Yeah.
a real whirlwind across their different shows. Market moves, specific industries, consumer habits, personal finance.
Starting with Ask for a Trend, market overview showed modest gains. NASDAQ Q leading, tech strong like NVIDIA.
Yeah, S&P and Dow up too. Finished positive after some early wobbles. A decent day for the averages.
But the real meat was in the specific trends they dug into, like the auto industry, with Kevin Roberts from Car Gurus. Surprisingly strong May sales.
Right. Despite all the tariff talk and affordability issues, Ford was up big, like 16%. Toyota up around 7%.
Why the strength?
Yeah.
Seasonal factors, Memorial Day.
Partly that, yeah. Return to a more normal sales month. But Ford also did that employee pricing for all thing.
Discounts driving volume.
Robert said affordability is such a headwind. Those discounts really help drive sales. He also flagged strong hybrid growth consumers like them, and Ford and Toyota are killing it there.
But the big question mark is tariffs, right? Did people buy now to get ahead of potential price hikes?
That's the million-dollar question, as Roberts put it. How much was pulled forward? Nobody knows for sure. Creates uncertainty down the road.
And pricing. Are prices actually going up yet?
Not seeing big average list price jumps yet. But he mentioned a trickle of announcements for June price increases. Expects more inflation in the second half.
Any mention of how specific stocks reacted? GM and steel tariffs?
Yeah, GM moved lower.
Sure.
There was some technical stuff about an executive order preventing tariff stacking, like not putting auto tariffs on top of steel tariffs. But the market still seemed worried.
Okay, moving from cars to snacks. Yahoo Finance looked at consumer behavior there too, people cutting back.
Definitely. Trading down from premium or indulgent options to cheaper private label store brands.
And it's hitting the big names, Campbell's.
Yeah, Campbell saw volume and revenue decline. Their CEO pointed to people cooking more at home, stretching budgets, being more intentional about buying snacks, less impulse.
Not just Campbell's, though. PepsiCo, Kraft Heinz.
Them too. Kellanova, the Kellogg's snack spinoff, all seeing lower snack volumes bought. Shows budgets are tight, even for small treats.
Holidays are key for these guys then, like 4th of July. Need good weather, right price.
Absolutely. Good weather gets people out, buying chips and dips. Bad weather, like Memorial Day, might have hurt sales. Price point is crucial. If Tostitos feel too expensive, people might just skip them.
Speaking of adapting to consumers, McDonald's is bringing back the snack wrap.
Big news for fans. July 10th, back on the permanent menu. Been gone since 2016.
And the timing isn't random, is it? Their U.S. sales have been weak.
Yeah, same-store sales declined Q4 last year. Decline accelerated Q1 this year. They're trying to fix a value misperception, people thinking they're too pricey.
Plus, that E. coli issue didn't help momentum.
Definitely not. So bringing back a popular, probably affordable item like the snack wrap looks like a direct play to boost traffic and improve that value image.
Makes sense. Fits the pattern. People still like treats, though, right? McFlurry mentioned.
Yep, McFlurry with Oreos still popular. Smaller, affordable indulgences are working.
Okay, let's broaden out to the market minute and wealth building mistakes segments. Market was green overall.
Yeah, bounced off lows hit after those OECD forecasts came out. Shows how sensitive things are. Investors were watching for trade deal news.
Specific stocks moving. Constellation Energy.
Up big time. Meta signed a huge 20-year deal to buy nuclear power from them. Fuels Meta's AI, keeps an Illinois nuclear plant running. Big deal.
And Dollar General. Ties back to the budget consumer.
Exactly. Stock was up. Beat Q1 estimates, raised guidance. CEO said they're uniquely positioned for this economy. But even they warned about tariffs. Shows everyone's watching that.
They also touched on some non-market policy stuff, student loans and Social Security.
Yeah, the Trump admin pausing the benefit cuts for defaulted student loan borrowers. But still going ahead with wage garnishments. Affects a lot of people, especially older folks.
And issues accessing Social Security services, phone restrictions causing problems.
Big problems, apparently. Data suggests nearly 2 million extra trips to field offices needed per year because you can't do as much over the phone. Tough for seniors, rural folks. Understaffed offices, long waits, can't even change bank info easily without internet.
Wow, real practical impacts of policy changes. The wealth segment had portfolio advice, too. Alessio Donis from Invesco.
Yeah, he advised sticking with defensive, low-volatility sectors and hammered home diversification the only free lunch. Avoid putting all your eggs in one basket.
What was his take on the Fed? Influenced his advice.
He thinks the Fed's neutral, maybe leaning towards cuts, but the key question for him is why they'd cut. Low inflation or faltering growth.
And he thinks it's more likely growth concerns.
That's his read. Fed more worried about growth slowing down. And that view supports being more balanced and defensive in your portfolio, even if the market seems okay right now.
Interesting distinction, not just if they cut, but the reason signals different things about the economy.
Precisely. He sees potential weakness as the trigger, hence the defensive tilt.
The segment also had tips for a mid-year financial check-in.
Yeah, practical stuff. Look back. Income, expenses, debt, savings versus expectations. Figure out what you could control, what you couldn't, like inflation, and cut yourself some slack. It's been tough.
Specific budgeting tips. Write it down.
Yep. Rewrite the budget. Use wish lists online. Don't save credit cards. Wait before buying non-essentials. Unsubscribe from tempting emails.
Shop your closet first.
Ah, yeah. See what you already have. And buying dupes is okay, legit inspired by stuff, not fakes.
But also budget for fun. Vacations.
Crucial point. Budgeting isn't just deprivation. Make room for priorities, things that bring joy. Balance is key.
Good advice. Okay, shifting again, excerpts from the Opening Bid podcast on Yahoo Finance. Ben Harris from Brookings on trade tariffs.
Yeah, he had a pretty critical take, called the Trump admin's approach experimenting. Pushing the economy, consumers, partners to see what happens with these high tariffs.
He put the tariff rates in context. Historically low, then creaking up.
Right. Average was 1.5% for years. First Trump admin took it to 3%. Now, he said it shot into the high 20s before backing off some. Still sees it as very much an experiment.
An experiment he thinks isn't working.
He was blunt. Hasn't been working well. Cited inflation, retaliation from other countries, corporate investment uncertainty. Thinks they maybe realized they went too far initially.
How did he compare it to the Biden administration?
Said Biden basically adopted the first Trump admin strategy, kept existing tariffs, didn't add broad new ones, sees the current admin as much more aggressive with its authority, raising legal questions.
And his prediction for this experiment.
Going to end very poorly. He even referenced Jamie Dimon's warning that the worst impact is yet to come.
What did he see as the worst outcomes, not just high prices?
Shortages. That was his big worry, especially for things like low-margin generic drugs. If tariffs make them unprofitable, we could see shortages. And layoffs from tariffs would be awful, too.
But he did find some positives in the admin's economic focus, beyond tariffs.
Yeah, he credited them for wanting to tackle government spending and inefficiency, even if he dislikes specific efforts like the Doge thing. Acknowledged waste is a real problem.
And in the reconciliation bill, things to encourage investment.
He liked incentives like faster write-offs for equipment, saw it as a way to potentially offset the negative tariff impacts by boosting domestic investment. Also thought the first Trump admin did okay identifying trade problems via investigations, even if he disagreed with the tariff solutions.
So, a nuanced critique. Dislikes the tariff strategy, but sees some valid points elsewhere. What about general investor sentiment from Yahoo Finance?
That segment sounded a bit more optimistic, actually. Noted earnings outlooks are improving as reporting season ends. Analysts stopped cutting estimates.
Why the shift? A feeling the worst policy fears are receding.
That was the suggestion. Maybe a perception of softening in policy, administration reacting to data, feeling like the worst-case scenario on trade might be avoided. Still need clarity, though, to muddle through.
Did they think tariff impacts are already baked in?
Some debate there. They estimated the overall rate might settle around 15%. S&P earnings were down 7%. So maybe some downside is priced in.
But the uncertainty itself is hard to price.
Exactly. Called the uncertainty unprecedented. Said companies are still frozen on big decisions like CapEx and hiring. And noted bears have been wrong lately. Markets held up.
What about inflation from tariffs? Seen yet?
The guest thought the real impacts haven't hit broad inflation data yet.
Yeah.
Maybe a temporary bump later, but hopefully not persistent.
Okay, let's move to the catalysts segment. Trending stocks. Hims and Hers, Joby, Pinterest.
Right. Hims and Hers buying Zava in Europe to expand telehealth.
Right.
Joby Aviation exploring an air taxi deal in Saudi Arabia. Pinterest upgraded by JP Morgan on ad platform diversification.
And back to auto sales again. More detail on Ford.
Yeah, reinforcing the plus 16% May jump driven by trucks, SUVs, hybrids. That employee pricing was key, cynical maybe, but it worked for market share, even if it hurt margins short term. Price hikes expected, especially in Mexico-made models facing tariffs.
Korean automakers Hyundai and Kia did well too. Kept prices flat.
Yep, plus 8% for Hyundai, plus 5% for Kia. Holding prices steady raises the question of when they'll have to hike.
How are different car makers handling potential tariff costs? Luxury versus mid-market.
Big difference. Porsche plans to pass most costs on desirable product, less price-sensitive buyers. Mid-market cars can't do that easily, too competitive.
So others might have to eat the cost. Korean brands moving production.
That's the talk. Moving production to the U.S. is tough, costly. Likely means accepting lower margins to keep market share, rather than risk demand destruction with big price hikes. The potential profit hit estimates were huge. $1.5 billion for Ford, maybe $5 billion for GM without mitigation.
When might tariffs actually show up in inflation data? Fed views.
Atlanta Fed's Bostic said maybe in the coming weeks, wasn't clear in April data yet. Steph Roth from Wolf Research expects systemic effects in the June, July, August prints, so reported later this summer-fall.
Catalysts also had Mike Casper on small and mid-caps. Need stronger growth to outperform.
Yeah, that was his main point. Russell 2000 needs better fundamental growth than the S&P. He also wondered if some Q1 small-cap growth was just tariff pull-forward buying, adding to uncertainty.
But small caps have less foreign exposure, right? That helps with tariffs.
Significantly less. Casper gave numbers. COGS from foreign sources, 40% at 50% for S&P. Foreign revenue, 20% in P, 33% for S&P. Tech is exposed across the board, but overall, small mid-caps are more domestically focused.
So potentially less vulnerable. Could policy help them?
Uh.
Reconciliation bill stuff like R&D expensing.
Could boost CapEx, yeah. Bonus depreciation, too. But the uncertainty itself is the risk might make companies pull back anyway. Casper saw large tech, like Microsoft, maintaining spending in Q1 is a good sign, potentially helping smaller suppliers if it continues.
Casper also had that interesting take. Stalling economy worse for stocks than a failing one?
Counterintuitive, right? His logic, a failing V-shaped recession, like 90 or 20, is quick. Sharp washout, clear policy response, Fed cuts fast, clear recovery, better for stocks long term.
Whereas a stalling economy,
like 0809 or 001, is dragged out. Slow recovery, less policy clarity, worse for stocks because the uncertainty lingers. He thinks a quicker washout is actually preferable for the market.
fascinating perspective. Okay, wrapping up Yahoo Finance. Market domination, closing bell segments, market finished green. JOLTS data helped.
Yeah, Dow, S&P, NASDAQ, all up. Took off after JOLTS job openings data came out.
JOLTS was better than expected, showed labor market strength.
Openings rose slightly as 7.39 million defied expectations for a drop. Market seemed reassured, saw it as resilient.
Joe Rusella from RSM commented, tariff impacts timing.
He saw JOLTS confirming labor strength, thought tariff price effects might hit around July, maybe job effects around then too.
Technical view from Jared Lickey, Dow streak, NASDAQ Q breakout, tech leading.
Dow's fourth green day, NASDAQ sideways for 2 months, just barely breaking out. Tech, XLK definitely leading. Energy second. NVIDIA was the star.
NVIDIA hitting records. Biggest stock. Broadcom too.
NVIDIA called biggest stock in the known world. $3.444 trillion market cap, breaking higher. Broadcom, new record high. Lickey saw $150 potential. Called it a risk-on day, promising breakouts.
Dan Gender's take on market resilience, less surprising now.
Yeah, he wasn't surprised. Said market hates uncertainty, which tariffs provided for weeks. Now sees a more sanguine, optimistic mood. Thinks market believes Trump likely gets deals done favorably for the U.S. Back to fundamentals.
And he thinks fundamentals are good, market cheaper, earnings up.
Yeah, PE ratio down 5% from start of year, earnings up 8%, sees an 8-9% type of environment, potential with dividends, calls it a crosswind, if not a little bit of a tailwind.
But Jeff Klinghoffer, fixed income guy, more cautious. Tariffs are an attack.
Much more cautious, sees lots of noise, crux unknown, direction is increasing tariffs. Big question. Can consumers absorb price hikes or do companies eat margins? Worried about Main Street versus Wall Street softness.
Gender acknowledged tariff uncertainty, but stuck to positive U.S. fundamentals, stronger than rest of world.
Basically, yeah, U.S. economy holding up better. Tariff impact, especially China, still on his wall of worries, but overall constructive.
Fed view, reactive to jobs, on hold.
Gender thinks so. Fed waiting for clearer signals from the labor market before moving.
So Gender's advice, look for pullbacks, cheap stocks, energy, tech, financials.
Stock pickers market, he says.
Yeah.
Energy, Philip 66. Tech beyond AI, microchip technology. Financials, Capital One post-discovery deal, needs old-school research in this environment.
Yahoo also covered Tesla governance issues. NYC controller Brad Lander.
Yeah, Lander representing NYC pension funds, big Tesla holders, long-standing concerns. Want a full-time CEO, pay tied to that, independent board oversight.
Specific demands, time commitment, succession plan, independent director.
All that. Clear time commitment from Musk, who runs 5 other companies. Clear succession plan. A truly independent director, not a friend or relative. Limits on outside board commitments.
Engagement hasn't worked well recently. Tesla moved to Texas.
Limited success, Lander said, especially since the move to Texas and by law changes limiting shareholder suits. He sees it as eroding shareholder governance.
Their goal is real governance for Tesla's future, considering selling if no progress.
That's the message. Letter starts the process, scaling up options. Want the board listening. Selling is a possibility down the line if Tesla keeps resisting.
Even though NYC funds made huge money on Tesla historically,
Lander acknowledged the massive gains, 21,000% since IPO, said the push isn't about past returns, but about ensuring it's a good stock for the next 5 years through proper governance.
finally market domination overtime, HPE earnings beat, cyber strong.
Yep, HPE raised outlook slightly. Cybersecurity space, like CrowdStrike, doing well.
Dollar getting attention. Recent bounce seen as technical relief after hitting a 3-year low. Might have more legs short-term due to extreme conditions short covering.
But fundamentally, he sees a downtrend, stagflation risk. That's his first reason for a weaker dollar long-term. Heightened risk the U.S. enters stagflation. Slow growth, high inflation. He linked this risk partly to tariffs pushing the average rate over 15%, highest since 1938.
But the source cut off before his other reasons.
Unfortunately, yeah. We only got reason 1 for the fundamental downtrend view.
Okay, so dollar bouncing short-term, but fundamental worries, stagflation, tariffs, linger.
Seems to be the picture presented there.
Also, conquer trading and investing takes us inside their view of crypto and macro, a different angle.
Yeah, the speaker there noted Bitcoin holding around $104,324, watching levels. Saw short pressure on Cardano, longs holding in Ethereum.
He had a specific technical take based on NVIDIA. Massive compression.
Right. NVIDIA hitting a stop loss after, he said, 11 down days in a row. He saw that as signaling major compression, market ready for a big move. Wasn't sure if it applied directly to Bitcoin, though.
His overall market mood wasn't super bullish.
No, it explicitly said he was not the most bullish, felt unsure for Bitcoin. Saw a risk-off market apparent, equities near lows, oil breaking down.
Macro indicators he watched: gold, supercore PCE.
Gold consolidating under resistance. Noted supercore PCE, excluding things he thinks should be included like housing, turned negative. Made him wonder if the Fed is behind the curve on disinflation.
But contrasted that with the soaring Atlanta Fed GDP tracker, 2.2% to 3.8%.
Huge jump. He wasn't sure why, technical adjustment or just reversion. Saw strong Costco earnings as a positive consumer sign, though.
What about treasury yields? Big consolidation on the 10-year.
Yeah, about a year long. He thinks a break implies a big move's coming. Market might expect lower yields, but he thinks higher, while admitting he's often wrong. Saw a sell impulse in bonds.
Currency charts reminding him of past patterns: DXY 2016-18, USDJPY 2007-08.
Yeah, seeing historical echoes. Wondered about a head and shoulders on USDJPY, but wanted confirmation.
And he brought up Luke Gromen's view on U.S. capital controls.
That was a big one. Groman apparently sees them as inevitable. Referenced Section 899 in recent legislation, potentially giving scope to transform the trade war into capital controls.
Wow, that's a major escalation beyond tariffs.
Huge potential shift. The speaker also reflected on missing the big trades in 2022, should have been short bonds, long Bitcoin earlier, didn't grasp the debt crisis ramifications then, interest cost defense spending. Yeah. Mentioned Truck and Miller.
He had a scenario involving the Fed reinflating global flows out of tech.
Hypothetical. If Fed reverses course, they aren't now, and money flees U.S. tech, then tech drops. But maybe bonds, gold, Bitcoin go up. But they'd immediately question if bonds would really go up in that scenario, recalling a time they didn't. Complex.
Concluded with Gromen's view of return to growth after potential carnage.
Yeah. Acknowledge potential disruption, but ultimately risk assets ascend again.
And we also got a quick inflation update from Josh Olszewicz, his true inflation data.
Right. Said his measure came back down from 2.10% to 1.9%.
His take on tariff impact based on that.
Said we need to see how it settles. But based on his current data, doesn't quite look like we're going to get runaway inflation off the tariffs yet.
Important counterpoint. While others expect tariff inflation later, his current data isn't showing runaway signs so far.
Provide some specific data nuance to that whole debate.
Okay. We have covered a ton of ground. Bitcoin tech and value, macro clashes, consumer habits, corporate plays, market chatter. Let's try to synthesize, pull it together, relate the pieces, spot the clashes.
Synthesizing the data. relating and contrasting.
Yeah,
Yeah, the big takeaway is just complexity and contradiction, isn't it? You see it everywhere.
like the macro outlook. OECD gloom versus Dale's dismissal versus Trump admin optimism. Completely different takes on growth and inflation.
In the market seems resilient.
Yeah.
Tech breaking out despite the gloom, which maybe aligns more with Dale or the idea that bad news is priced in.
Tariffs are the perfect example of the confusion. OECD Harris.
Yeah.
Drag, inflation, bad experiment.
Then Yahoo segment saying maybe it's baked in at 15%, but uncertainty is unprecedented, freezing companies.
Then you see companies adapting discounts, shifting production, but margins suffer, price hikes still expected. When does the real impact hit?
And the inflation timing debate. Bostic Roth see it coming later this summer-fall. Olzevich's data says not run away yet.
Market strategists split too. Gender sees good fundamentals, stock picking. Klinghoffer sees an attack, unknown impact on consumers versus margins.
Even within Bitcoin, long-term MVRVZZ isn't at cycle top levels. Short-term heat map shows specific leverage risks right now. Different time frames, different signals.
Plus all the direct challenges. Dale versus OECD. Views on priced-in risk versus future impact. Who eats tariff costs? Resilient jolts versus future weakness worries. Casper's stalling versus failing economy idea. Krugman's trade restriction warnings.
It's not a clear picture. It's multiple pictures layered on top of each other, sometimes contradicting. The underlying assumptions are even being debated.
Which brings it back to you, listening to all this. Why wade through it? Why does it matter?
Connecting to you, the listener. Because each piece gives you a different tool, a different perspective. Understanding liquidation heat maps helps you see short-term crypto risks fundamentals miss.
MVRVZ's score gives that long-term historical context for Bitcoin value. Are we in a frenzy or a funk, historically speaking?
The macro debate growth, inflation, Fed that directly shapes investment choices, defensive or risk-on, stock picking or indexing.
Watching consumer behavior snacks, cars tells you about the real economy's health, which companies are navigating well.
And tariffs. Yeah, they touch everything. Costs, prices, investment, jobs, market sentiment. You have to track that debate.
So the goal here is giving you these nuggets, the data points, the expert takes, the contradictions so you can connect the dots.
Make more informed decisions, have those aha moments, feel more confident navigating even when the experts disagree.
It's about equipping you to think critically, right? Understand the forces at play.
Yeah.
So, as we wrap this up, we've seen this landscape of conflict. Bitcoin's signals, macro outlooks clashing, tariffs as an experiment, different analysts seeing different things in the same data.
Policy itself described as uncertain, unprecedented. It's a lot to process.
Which leads us to a final thought for you to chew on, based on everything we've heard today.
The provocative thought. In a world where expert opinions on the economy and markets are sharply divided, where policy itself is described as experimental and unprecedented in its uncertainty, and where different data points can seem to pull in opposite directions, what process or framework does it take for you to distill these competing signals, to decide which analyses or data points carry the most weight in your own assessment, and ultimately to form your own informed perspective when charting your financial path forward?
Something to think about until our next deep dive.
Markets move fast. Pinpoint your next profit window and seize the moment.